Welcome to Finance in 5. In response to recent questions about mining stocks, today we're going to look at how they're useful and at a few easy portfolio boosters to help you cut through the noise and make smart investment choices in these companies. What does this week's drop in precious metals prices mean for miners and for gold's longer term outlook and silver? You're not going to want to miss these crucial answers coming up today on Finance in 5. Welcome back, dear friend. In recent months, we find ourselves noticing that every time there's a vaccine announcement, the gold price takes a hit. Maybe it's short-term thinking, markets acting on instinct, or perhaps it's just people not looking at the long-term big picture. But what we're seeing happening here is that when market participants hear news about a vaccine, money temporarily rotates out of gold and gold miners and silver and flows into other sectors, whether it's pharmaceuticals such as Pfizer or Moderna or other places. And yet, many fans of gold and silver and viewers of this channel adopt a long-term view, and for them, gold isn't a fear trade and it's also not merely a hedge. Ultimately, gold's price moves with the expanding monetary base, and as we've talked about before, when the collapse of confidence in government accelerates. This is why I think that the election of Biden,
we can proclaim,
if it takes place,
the palmist who wrote,
is likely to be extremely bullish for precious metals prices if, for instance, lockdowns next year lead to an increase of personal or business bankruptcies or civil unrest, which effectively are proxies of confidence collapsing. But then, whoever would take the White House, the die was cast long ago. This era of perpetual borrowing by governments is running into a brick wall. Central bank currency creation has gone completely bananas this year. However, the gold price is yet to catch up with that. We can actually look at how this relationship has unfolded over time. If we trace back the price of gold and the expansion of the US's money supply, or as some people call it, the monetary base, we see an extremely close correlation which goes back many decades. This chart illustrates about a 6,000% increase in the US's monetary base since the early 1970s, and that was the time when the US decoupled the global monetary system from the gold standard. This is compared to a roughly 5,000% increase for gold prices during the same time frame. Therefore, gold is lagging a little bit now, which is very bullish for the yellow metal going forward. After all, the more gold lags now, the more catching up it's likely to do later. Also, vaccine or not, the US economy, as well as a lot of other major economies around the globe, will very likely continue to need substantial monetary stimulus injections going forward. In fact, a staggering $10 trillion Fed balance sheet is likely coming by the end of the year or early next year, as it hit around $7 trillion in June. The other way of understanding all of this is just by saying that currency units go up while gold ounces in the Earth's crust remain fixed. Therefore, the more currency is created, the more currency you can attribute to each gold ounce. Gold's move upwards in price could lag this currency creation by a little bit, and this usually seems to be the case. Theoretically, we could expect to see gold at $3,650 or $3,800 as early as a year from now, but realistically, that price target might be a little further down the road. But make no mistake, it's coming. It's impossible that gold won't continue to rally in price over the next few years. And if that's all you take away from this video, that gold will rally in silver, then it's still worth you having watched, because even though we hear it so often that it becomes obvious, knowing that it's true and not having some kind of strategy isn't a great idea. Even if you don't have much in the way of savings, gold and silver are still a useful component within a diversified portfolio. So I would consider a stepwise plan of accumulation, whether quarterly or dollar cost averaging every month, so you can take advantage of the imminent price rises and protect your purchasing power. Now might not be a bad time to buy in. I mean, silver and gold are at lows, aren't they, this week? They've really dropped, so what a great opportunity. As we continue through this next decade, we'll see gold catch up with this ever-expanding monetary base. Gold could reach roughly $3,500 by year-end 2022. Think about that. 2 years from now, $3,500 gold. That's roughly double its present price. But I just want you to imagine two friends for a moment, John and Bob. They're both 40 years old, they both have $100,000 in savings. On the 1st of December 2020, John buys all the gold he can get his hands on for $100,000. How much does he get? Well, according to the latest price, he'd get 55 gold ounces for $99,509.85. Let's just imagine that that's what he does. The extra money could be delivery and insurance, who knows. His friend Bob, what does he do with that $100,000? Nothing. He leaves all that money in the bank. And as we know, if you hold any central bank printed currency, you're subject to their constant money printing, which leads to inflation, which undermines your purchasing power of those savings. So for the next 2 years, let's be generous and assume that there's only 1.5% inflation per annum. How much would each have on the 1st of December 2022 if we assume that on that exact date, 1st of December 2022, the price of gold is $3,500 per ounce? Great question. John bought 55 gold coins, so he'll have 3,500 times 55, which is $192,500. Meanwhile, with inflation running at 1.5%, Bob will have 100,000 times 0.985 times 0.985, which is $97,022.50, which is almost exactly half. In fact, it's 50.4% of what John has. And I get it, these are big ifs. None of us know that gold is going to go up that much. But my point is that by doing nothing, Bob has had his purchasing power slashed in half just by choosing cash in the bank as his preferred asset class to hold on to, as opposed to gold for his savings. John can buy twice as much stuff at the end of 2022 just by holding on to the right asset between now and the end of 2 years from now. This brings us to gold miners. Finally, we've got there. The one interesting thing about precious metal mining stocks is the fact that their performance will usually move in the same direction as the precious metal in question, but with twice the amplitude. For example, recently, gold corrected by 11%. The large cap gold miner ETF called Van Eck Vectors Junior Gold Miners, it declined by exactly 2 times gold's 11% drop. This is typical in either direction for gold and silver and gold mines. Larger cap gold mines typically move at around 2 to 2.5 times the amplitude of the underlying asset. We can see that in these charts. So look at the rise in this chart since the mid-March bottom. We see that in 2020, the March trough to August peak increased by about 225%, while gold increased by only 43%. So what does that mean? It means that to the upside, we saw moves of more than 3 times or 4 times the price of gold. This is also a positive indicator that implies that we should see moves of around 2.5 to 3.5 times in gold miners relative to gold when future rallies take place. So back to our example earlier of John and Bob. Imagine John put all of his money in gold miners instead of buying 55 gold coins. If the ratio I just mentioned was to hold and gold miners outperformed gold by 3 times in future rallies, what would his holdings be on December the 1st, 2022 if we assume the same conditions mentioned? It's almost 6 times the principal balance. 3 times the value that he would have held in gold, so 3 times 55 ounces, which are each worth $3,500, so 3 times $192,500, so that's $577,500. That's almost 6 times the principal balance, all from this leveraging effect. So you get the uptick in value of the gold itself, which rises in currency terms to reach $3,500 in 2 years' time. You also get the gains of these mid-tier gold producers adding leverage on top of that to compound your returns. For a rough and ready, relatively conservative estimate, we would use 2.5 times for big cap miners compared with around 3 times for small to mid cap gold miners. So if we see a move of around 32% by the end of 2021 in gold and 85% by the end of 2022 in gold, which would be consistent with price targets of, say, $2,500 and $3,500 gold, we would expect to see a move of roughly 80% in large caps, surge of 96% in smaller mid caps by the end of 2021. And at the end of the second year, we would expect to see 212% in large caps and then 255% in small to mid cap miners from now until the end of 2022. So if you think about those underlying projections, that would mean that this gold mining ETF could be around $67 and then $104 at the end of 2021, and at the end of 22, it could be $188. So these gains are absolutely substantial. What did I mean earlier when I mentioned the Van Eck Vectors Junior Gold Miners ETF? What is that bunch of word salad? What is it? Well, you probably already know that an ETF or exchange-traded fund invests in a number of companies which are similar in terms of market capitalization and sector exposure. The idea behind this is that if some of the companies have a bad year, others in the mix will overperform, which will make up for any shortfalls, ultimately guaranteeing a decent rate of return for investors year on year. Because of the volatility associated with mining stocks, there's a risk that you can be unlucky and pick a company which underperforms for reasons which are completely outside of anyone's control. Mining assets in certain countries might be subject to continuing lockdowns, closures, or other political instability. There might be equipment failure or unexpected bankruptcies. For the most part, mid-cap miners are less risky, and by mid-cap we're talking mines that produce 250,000 to 1 million ounces of precious metals per year. Operating costs of the top-tier miners can often be higher, But anyway, buying shares in a mining ETF, there's a small chance that the upside won't be quite as high as the performance of certain companies may lag behind a little bit. But your downside risk is minimized by this averaging effect, and this is why these are popular instruments. So if you look, for instance, at the summary and top holdings of the VanEck Vectors Gold Miners ETF, we can see that it invests in these companies which are listed here.